Thank you for joining us. I'm Gord Long with the Financial Repression Authority. Today I have the privilege of introducing Wolf Richter to our Financial Repression Authority viewers. Wolf is the publisher of the wolfstreet.com website. Welcome, Wolf.
Thank you, Gord, for having me on your show.
I appreciate you joining us here. Sorry to mispronounce wolfstreet.com. I've been a follower of your site for a long time, and I really enjoy it. You write about a lot of things that others are not covering, and some of them we're going to talk about here today. But a lot of our viewers may not be familiar with your site, your writings. Could you give an overview of your background and why you started the site?
Yeah, I started wolfstreet.com about 2 years ago. It's the site that followed my prior site, which I shut down because of the name it had, Testosterone Kit. And it's dormant, but it had too many problems with the name, got blocked by ISPs and so forth. So I switched the name over, switched everything over. So I've been doing this really for close to 5 years now. My background is in business. I used to run in my early years a very large car dealership with 250 employees. I've then worked on Wall Street some and did a startup in Europe for 3 years and lived in a bunch of different countries. So this is really, for me, an opportunity to influence the debate a little bit about our financial system and business and the economy, and to show things that you cannot see in the mainstream media. I'm very much data-based. Some of it is opinion, but most of it is based on data that I extract directly from government reports, from company reports, and so forth. So it is very much in that direction.
I must say, it's very broad-based. You cover a lot of subjects and a lot of different views on it for our readers, our listeners to explore your site. Well, the concept of financial repression, I know you've written about it in the past. What does it mean to you, and how would you describe it to people? And what concerns do you see with it?
Yeah, financial repression is an insidious tool by which wealth gets transferred. And it means that the money that you earn doesn't compensate on your investment, doesn't compensate you for inflation. So when in Europe, for example, they have now official negative interest rates, so savers in Germany, they get zero on the savings. And even though they keep talking about deflation, actually it's inflation on average in Europe, and so your income from your savings gets eaten up. And the same thing in the United States right now, have a period of very low inflation, but it is growing. There's inflation pressure building up in the pipeline. We've seen that companies reporting that their cost pressures, they're starting to pass that on to the consumer. Some of the inflation measures have come up, and yet when you put your money in the bank, you get nothing for it. So your savings are shrinking. If you own government bonds, short-term government bonds, you're not being compensated for inflation either. And so, in other words, your financial returns are being repressed. And this is done artificially. This is not a market that's doing this. This is the central banks that are doing it. And that's why we call it financial repression, because it is actually a form of repression. And it's designed to shift money away from savers and from bondholders to others, usually the debtors, perhaps governments, large companies, and so forth.
So what is the goal? To offset the cost of the debt, the government's debt? Is that the central driving theme behind it?
During World War II, that actually was the case. So when there's a big war effort going on and it had to be funded, there was a big bout of financial repression for that purpose. Now it's there's some of that going on, but we have corporate borrowing hitting huge records. And if interest rates rose even just 2 percentage points for AAA borrowers, and they would rise a lot further for the lower end, and you would see spiraling bankruptcies. I mean, this is something that can hit the corporate world really hard. The United States government can always print more money, so it's not going to go bankrupt. Another states is another issue. Cities and states, yeah, we're having all kinds of states now financial trouble, and they can't afford high interest rates either. So there's a big pressure from those entities, from corporate entities, and from municipalities and states to continue this financial repression.
Yes, we're seeing a lot of bankruptcies, people in trouble in the high yield debt arena, leveraged loan arena, primarily coming from the oil industry, the commodities because of the pricing there. But we're also starting to see it in other ways in terms of these bankruptcies, more and more of them because they're so heavily leveraged. But in an era of financial repression, the whole one of the stated goals of low interest rate is to drive demand, to increase growth. And that's one of the reasons I wanted to talk to you today, because it should show up in the retail arena, the retail industries that are selling garments and various products. But we're not seeing that, and you've written about it extensively. What is going on in your mind in the retail space, right? U.S. retail space right now?
The U.S. retail space is in real trouble. The brick and mortar retail space, it has structural problems that won't get any better; they'll get worse. We have a booming online retail sector that is growing in leaps and bounds, and will continue to do that. So. Retail overall in the United States is growing at a very low rate, or it's flat. Sometimes it's declining. So it's not a fast growing market. So you have in this market, you have one slice of it that's getting bigger and bigger, and then the other slices are going to get smaller. And the slice that's getting bigger is online. The slice that's getting smaller is brick and mortar retail. And here you have a huge problem. Just this week, we had two major bankruptcies. FRA market stores in the New York City area, about 18 stores went bankrupt. Aeropostale went bankrupt. So there's two of them this week. We had in prior months, we had Sports Authority. We had all kinds of retailers go bankrupt. And these are brick and mortar retailers. We have Sears and Kmart that I don't know how they stay alive. They keep getting new money, but they're closing stores. They're shedding employees. They've been doing this for years. They're doing it in Canada. They're doing it in the United States. I mean, this is a very, very disastrous kind of business to be in, for these retailers. Now, there's some that are doing reasonably well, but overall, this is probably one of the toughest things to be in brick and mortar retail right now. And the bankruptcies are going to continue. That's just that's how this is going to get worked out. And some of those bankruptcies end up in liquidations, and others end up in restructurings, which points to the other problem these retailers have, which they have way too much debt. And so they're loaded up with debt, often by private equity firms. And now that sales are not doing well, they can't deal with the debt anymore. And that's when you have bankruptcies. Now, financial repression fits into this because the boomers in the United States are getting older, and many of them living off their savings, and the savings are not generating any more income. And the amounts of income that have been lost over the years are just staggering. And we're not talking about a lot of percentage points, but in terms of going from 3% earnings to 0%. But based on the trillions of dollars that are in savings, this is a gigantic income stream that has been stopped. And so these people are, they're redoing their budgets. They can't spend like they used to, and so they're cutting back, and they're struggling with it, and they're tweaking something here, and they're dropping something there, and they're switching to cheaper products, and they're doing all these kinds of things that are really painful to retailers. So if the official reason for financial repression is that it's supposed to create demand, like you said, Gord, it's not working. And which makes me think, because I'm not the only one, there's lots of people who see that it's not working, which makes me think that perhaps the officially stated reason isn't the real reason, that there's another reason for financial repression, like we mentioned before, and that this creating of demand is just, it's just smoke and mirrors, really, because it's not creating demand. It's destroying demand in a large part of the population.
And so you've got the savers, the retired people, others that just aren't making any income, so they can't buy. It hits the retailers. We've had the retailers in America, I would say, overbuild in bricks and mortars for the last decade. I mean, there's not an area. Our area used to be not that many malls around here. Now there's one in every corner. Big box stores, strips of them. I mean, it's probably the biggest employer in our area up here in the Northeast Boston, is just retail kind of space. So now you've got this wave to online shopping. And that's where you see the sales, as you say. It's Amazon. These are surging. People are buying online. I don't think that's a surprise to anybody, but it's killing the retailers, especially as some of them, Aerospecial you mentioned, where even fashions and clothes, young ladies' clothes, they're buying them online. They never did that before. But is the problem not just the retailers, but because they don't own the stores, they usually just lease them. Their debt is somewhere else. And as you say, they're over leveraged. But it's the owners of all this floor space. The REITs, are they the ones that are really, really in trouble here? Because they're going to be holding empty floor space pretty soon.
Right. And here we're going into commercial real estate, which is another bubble that we have experienced. And like you said, these REITs, these retail REITs are very much at risk. What happens right now is that you have two shopping centers that are not that far apart, and one of them will have an anchor store close, and then within a short time, another anchor store might close, and then the stores between get boarded up, and pretty soon that mall is dead. And then the traffic switches over to the other mall, and so you have a thriving mall that everybody sees and everybody goes to, and you've got a dead mall that sort of fades out of memory. And then you have a REIT that owns the dead mall, and so eventually they'll have to do something else with it, and maybe build office buildings and so forth. So they're having to deal with that. But this is something that's going on throughout the United States, that you have this process going on of dead malls, and there are websites out there that track these things, and you see videos of them, and drones fly through them and whatnot. But we don't usually see them because we don't go there. We avoid those things, and we go to the ones that are fairly good shape. So they're a little bit out of sight, but they're there. They're a financial drag on REITs. Now, in commercial real estate, we have had the most gigantic bubble ever. And overall, so that includes office, includes retail, it includes apartments and so forth. Overall, the current property values are about 23-25% above where they were at the peak of the prior crazy bubble in 2007. And so that bubble was crazy. Now we're even crazier. Even adjusted for inflation, we're higher than that prior bubble. And now we have seen it actually turn. So this year, the Green Street property price index, for the first time in years, it's flat or slightly down for the first 4 months of this year. And the cheaper spaces, the prices are dropping. Houston real estate, and that's office, and especially office, is in real trouble. We've seen trouble popping up in others. So the REITs are picking up on this now, and they're a little bit behind in showing that, but this is happening right now. So this year, 2016, is probably where the big turning point in commercial properties is occurring at the very beginning of this. And so when we look at retail properties, we will see a problem there. And even though it has not really shown up in the REITs themselves.
Well, I know up in the Northeast, I drive around, and almost any complex, office building complex, or big signs, posters on the sign, office space for rent, for lease,
Right.
Everywhere. And a lot of these are casualties of the housing bubble slowdown that various mortgage lenders, contractors, etc. But at the same time, Wolf, there's new office buildings and going up that they haven't even rent. It looks like on speculation. And they're wondering how long this can keep going on.
Well, it's in San Francisco. We had a huge construction boom, maybe similar like what you had in Boston. You can walk down the street in certain parts of town, and you can just see these brand new buildings. These towers go up left and right, and this is happening just when demand for office slacked off. I just posted an article on this debacle in San Francisco. So we're now seeing the numbers go south. And this was a boom that people thought would last forever in San Francisco. But now we have all these office towers under construction, coming on the market pretty soon, and with startup companies and other companies laying off people, you have demand for office space deteriorate. And you got to remember that these companies are buying they're leasing office space to warehouse it. They think they're going to grow into it, and so they lease a lot more office space than they need. And once reality sets in, they put that space back on the market as sublease, and the sublease is what kills the market. So now we're seeing sublease booming, and these companies that try to warehouse this office space. So this is office. In terms of commercial real estate, this is the office market that's now going south in some of the most booming areas. In terms of retail, it has different dynamics. You have a retailer that goes bankrupt or closes a store. That doesn't mean that the retailer stops making payments. The lease may go on, and it becomes part of the bankruptcy. Or if there's no bankruptcy involved, if like Sears just shuts down a store that it leases, it will have to continue to pay the lease rent and work out a deal with the landlord and try to sublease it. So this is not immediate. So when you see a store shutting down or a series of stores shutting down, there's a delay before this shows up in the numbers further down the road.
I look and I say, what's going to change and what's going to expand? And I'm referring to retail sales and growth. And I look at world trade is dramatically down. I measure Baltic dry shipping rates and amount of shipping cargoes. It's falling off the cliff. It's actually at a steeper decline rate than 2007, 2008 in terms of shipping. I look at containers, at cargoes. Then I look at trains. I look at trucks, movement of goods. All of them are down dramatically. I know you just posted this week an absolute fascinating set of pictures. I think there was like 280 locomotives that you had isolated, all parked out in the Arizona desert.
Yeah, right. These Union Pacific engines that were just on a siding, 292 of them. And this came along. I did this article along with a release of the data set by the American Association of Railroads with the April numbers for traffic, and it looked really bad. I mean, we know that coal and oil trains are way down, but now it's hitting intermodal, which is containers and truck trailers that they're hauling, and that was way down too. So this was really interesting. And when you have a bunch of railroads that are not shipping anything, they have to do something with the trains and with their rail cars. And so when we found via Google Earth these engines sitting in the Arizona desert, we posted that along with the article, and it's really good. But even more interesting are the comments. I got a lot of comments from readers saying, "Yeah, I saw the same thing over in this part of the country, and I saw the same thing over in that part of the country." And it's not just engines; it's rail cars. They're possibly parked across the country, and hundreds of thousands of rail cars. And some of them are tank cars. A lot of them are tank cars, but then there are others too. So this definitely, when you have I call it a transportation recession. When you have a transportation recession like this, it tells you something about the goods-producing economy in the United States, and it's not healthy.
Are we on the verge of a U.S. recession this year, 2016?
Yeah, I can see that. I mean, the goods-producing economy is probably in a recession already. Now, the service economy, and that includes healthcare. We got to remember about almost 20% of the U.S. economy is healthcare. When you think about that, it's kind of insane. But so long as healthcare is doing fairly well, the service economy is doing fairly well, and the service economy is still holding up. But it's shown weaknesses. The last figures were okay, but a few months before it was in decline. So we'll have to see how that works out. If service gives, if it starts to break apart, even in a minor way, I think we'll have a recession. With manufacturing and the goods-producing economy, the goods-consuming economy is already in trouble. So it just everything hangs on service rate.
A lot of concerns here. But Wolf, what's concerning you the most in terms of the U.S. economy? Is it in the retail side of it, or where is?
Yeah, right now, you can get an economy easily can get through a slowdown in retail or in services or something like that. What it can't get through easily is if there's too much debt out there. And that's what concerns me the most, is the amount of corporate debt, the amount of government debt, of state and municipal debt that's out there since the financial crisis. It has ballooned. Normally, we call this a credit cycle. Normally, you have a period when debt increases, when companies and governments are optimistic, and then things turn south and the companies go bankrupt and they shed this debt through bankruptcy. And then there's sort of a regeneration or a revival going on after the bankruptcy process. Now, when this was starting to happen during the financial crisis, the Fed stopped it with all its bailouts and the free money and the cheap credit. So that shedding of the debt part never took place. So we carried over from the prior credit cycle, we carried over all this debt into this current credit cycle, and we added to it. So now we're sitting on a huge pile of debt, and that's retailers, it's the energy companies, it's every company in the world. I mean, they're all piling on debt because it's cheap to do. And I mean, it's IBM, it's all the big companies, little companies, anybody who can borrow money is out there borrowing money. And that becomes an overhang of the economy. And when that turns, I think we'll have a real problem that far exceeds what a normal run-of-the-mill recession will do. You know, recessions occur. It's no big deal. The problem is the debt. When the debt blows up, and there's so much of it, and it's been delayed for so long, you have a gigantic problem.
Well, I'm a big student and follower of the credit cycle, and I watch it quite closely and have for years. It always precedes and gives me a lot of heads up. But one of the keys in the credit cycle is it's not the amount of debt you have, it's the amount of free cash flow or cash flow relative to the debt. And when I see EBITDA and free cash flow falling in corporations at the rate it's falling, it says there's an issue with the debt outstanding. But what it usually means is credit ratings getting lowered. And it's on my view that the credit cycle has turned, and it doesn't turn often. It's a longer cycle, and we're seeing it in distressed debt, et cetera. Did you feel that too, that the credit cycle has turned?
Yeah, definitely. I mean, the credit rating agencies have been on this downgrade tango now for months, and they are handing out downgrades by the dozens these days, and not just energy, but other companies too. You know, and they're downgrading AAA companies. You know, they're like Exxon. They're downgrading everything in the middle, and they're downgrading the chunk. So this has happened now. Another thing that we see that I just wrote about is bankruptcies are soaring, and that's a sign that the credit cycle has turned. When these companies can't get any more money. So in the United States,
when they can't roll over the money, that's been they keep rolling it over, and they just can't do that.
And they're, like you said, the cash flow isn't there anymore, and so now the lenders pull the plug. And we read about the bigger bankruptcies in the media, but in total, there were about 3,500 commercial bankruptcies in April, and that's up 32% from a year ago. There were about 680 Chapter 11 filings, so that's a restructuring, a bankruptcy where the company continues afterwards. And that was up like 61% from a year ago. Prior month, it was up 50%, over 50%. So these Chapter 11 filings are just soaring, and it's retailers, it's small retailers, bigger retailers, like we've seen. It's oil companies, all kinds of other companies. It's media, communication companies, newspapers. I mean, it's everything out there, And so we're looking at jumping bankruptcies, and that's a sign that the credit cycle has ended. And now companies are getting in trouble with the debt and the lagging cash flows. And so now it's time to clean this up. And the cleanup process may be a little bit painful.
Well, I usually watch the non-performing loans on the banks starting to increase. They're accruing more. Those are all happening. I look for the bank profits to be falling off, which they are. But I also look for them selling bad debts. And I've noticed on that, they usually, anything where the debt's 4 times the EBITDA, they'll hold that. Maybe it's on right on the line. Anything higher right now, they're selling. And if you look at it, many companies are 20, 40, 42 times EBITDA in terms of debt because the cash flow's falling off so fast. So the banks are just jettisoning these as fast as they can. They're having troubles finding buyers, which makes the price go down even lower, right? So that's a sign the cycle has turned when they start offloading on their books at a rapid rate. But we haven't seen in spite of what we just talked about in retail, that many bankruptcies relative to the amount of leverage that's out there and the amount of way revenues are and sales have been falling off.
Right. So the when you have a thousand smaller bankruptcies, the amounts aren't really that huge. It's when you get the big whales washing up on the beach. That's when you have big numbers show up, and that hasn't happened yet. We haven't seen a huge company go bankrupt like WorldCom or Lehman or any of those. I mean, when that happens, it really makes a big splash.
It gets the press and the visibility, but you make a very good point. Yeah, because it's the small business failures that really are noticeable, but they get no visibility because they're just almost considered noise, but they're not. It's the number of them that are failing and the number of them that are not starting too. They're just because they just think the risks are or too high or whatever. When money's this cheap, this is a little bit alarming because usually that's when you get malinvestment and overexpansion.
Well, that's ironically what's different this time is that normally when we have end of the credit cycle, it's because the Fed raises interest rates and ends up triggering a recession because we have too much inflation and it's worried about the economy overheating. This time around, the Fed still has the foot on the accelerator all the way, almost all the way. Interest rates are still near zero, and we're at the end of the credit cycle, and the Fed hasn't raised rates yet. So this is going to be interesting because that's not how it normally happens. And we're a little bit in unknown territory here thanks to the Fed's experiment. And we'll have to see how that. It seems unimaginable. How can you go bankrupt when the money is free or nearly free? Yeah, but for companies that are in trouble, the money is no longer free. It's getting very expensive for them. Like you said, lenders are now getting leery, and for a company with a triple C credit rating, for example, to borrow money, it has to pay quite a bit. It's in the double digits. And this may be tough to do if your cash flow isn't there. So then now on the bottom end, these things are starting to get pretty complex, I think, for some of these companies.
Yeah, it's like going bankruptcy. I think Will Rogers once said, I went bankrupt quite slowly, then all of a sudden very rapidly. So it drags on longer you think, and then it just kind of accelerates out of nowhere. It seems, but the signals are usually very, very clear that they're coming. We have to wrap. Wolf, any key messages you'd like to leave with our viewers in terms of what you see coming this year, what they should be concerned about?
Yeah, we'll definitely watch the debt. We'll keep an eye on that on Wall Street. This is something we have been watching. I turned bearish on the bond market in 2014, maybe a little early, but it was cracking back then already. I think this is a slow-moving process until suddenly it isn't, and it moves very quickly all of a sudden. But at this point, we're in the slow-moving stage, and it's like Chinese water torture. You get a little bit, and then right now, we've got 3 months of recovery, and it's going to turn south again. So this is going to be a long, drawn-out process. I don't expect any sudden collapse here this year, but I expect this to be very difficult.
Is stagflation a way of describing what you see coming?
Yeah, and people say that there's no demand, there shouldn't be deflation, but I see inflation building up in the pipeline. I can't help it, and I see prices go up here and there. I see companies complain about cost increases. There's all kinds of inflation now building up in the system. Whether they can push it through to the consumer remains to be seen. Some of it has gone to the consumer already. I mean, the consumer price index, the core consumer price index, is already upticked fairly significantly, as have some other inflation measures. So if that continues like this, then we have another problem in that the consumer now has to pay more for the same goods, and that doesn't show up in the dollar denominated retail sales, but it shows up in the unit sales. And these retail sales are measured in dollars, and the prices increase, and the consumers buy the same number of units. Actually, sales go up, and that's why everybody in retail wants inflation. But the consumers don't have any more money, so they can't spend anymore. So probably the unit sales will go down, which is a sign of slacking demand, and then there'll be consequences for retail sales because eventually they'll have to cut their prices, and you're back to losing money, losing margins, declining revenues, that kind of scenario.
Wolf, how can our readers follow your work, your writings, your commentary?
Yeah, the best way is to go to wolfstreet.com, and there's a place you can sign up for email notifications, but you can just come to it every day, and we'll have 1 to 4 new posts every day, all in that same manner that we're looking at. We don't look at politics. We're strictly focused on the economy, on finance, on the market. So it's an area that's trying to be politics free. So relax and look at the economy on our side.
Well, thank you very much. Very much appreciate it. Enjoyed the conversation. We'll have to have you back sometime this year.
All right. Thank you, Gord. It's my pleasure.
Talk to you. Bye-bye.